Have you ever watched a giant fall? Not because of some powerful enemy, but because of the very hands it trusted most. Toys R Us. For decades, it was the undisputed king of toys, a paradise for children, a temple for collectors. Its aisles were magical. Its mascot, Geoffrey the giraffe, was a household name. And yet in 2017, the giant stumbled and fell, filing for bankruptcy. What happened? It wasn't Amazon. It wasn't Walmart. It wasn't even a sudden drop in toy sales. No, the real story is much darker. Toys R Us was brought to its knees by the very people who claimed to be its saviors, private equity investors. They arrived with grand promises to unlock value, to streamline operations, to make the company leaner and more efficient. Instead, they loaded it with an impossible burden, between $5 and $7 billion in debt, and left it choking on interest payments. This is the chilling story of how financial engineering can destroy even the most iconic, beloved brands. If you're ready to see how a giant can be felled from the inside, comment below, "I want to know the truth." And make sure you subscribe, because you won't want to miss our next episode, where we'll expose the hidden dangers behind deals that look too good to be true. Let's rewind to 2005. This is where the story truly begins. Toys R Us was acquired in what's known as a leveraged buyout, or LBO, by a group of private equity firms. So what exactly is an LBO? In simple terms, it's when investors buy a company using mostly borrowed money. They use the company's own assets and its future cash flow as collateral for the loan. Imagine buying a house with a 90% mortgage. You don't have to put up much of your own cash, but the new owner of the house, in this case the company itself, is now responsible for that massive mortgage payment month after month, no exceptions. For Toys R Us, the deal was structured like this. The purchase price was around $6.6 billion. The private equity firms contributed only $1.3 billion of their own money. The remaining $5.3 billion. That was pure debt, loaded directly onto the company's balance sheet. Overnight, Toys R Us went from being a cash-rich retailer to a company whose primary mission was to serve its lenders. Every single dollar of profit it made went first to paying interest and principal on that enormous debt. Very little was left over for the things that actually matter: growth, innovation, or building a modern e-commerce platform. But it wasn't just the sheer size of the debt that was suffocating. It was something called covenants, a set of strict financial rules baked into the loan agreements. These covenants forced Toys R Us to maintain certain financial ratios, like its debt-to-equity ratio or its interest coverage ratio. If the company missed these targets, even by a tiny margin, the lenders could trigger a default. They could demand immediate repayment of the entire loan, or even worse, seize control of the company. Toys R Us was walking a financial tightrope, and every small misstep, every slow sales quarter, could spell complete and utter disaster. Now let's look at the devastating impact this had in real numbers. Before the LBO, Toys R Us had the freedom to invest its profits back into the business. They could have expanded stores, upgraded their website, launched loyalty programs, and created amazing in-store experiences to compete in a changing world. But after the buyout, the picture looked dramatically different. The company was forced to pay around $400 to $500 million every single year, just in interest payments on its debt. And its budget for research, development, and digital investment, it was less than $50 million a year. Do you see the incredible imbalance there? The company was literally paying more to its lenders than it was investing in its own future. Think about it. That's like trying to renovate your house while giving 90% of your income directly to the bank. You can't afford new paint. You can't buy new furniture. All you can do is scrape by just to make that interest payment. While Toys R Us was trapped in this cycle, its competitors were racing ahead. Amazon was pouring billions into logistics and its online marketplace. Walmart was upgrading its supply chains and store formats. Target was brilliantly integrating its digital and physical retail experiences. And Toys R Us, its stores grew old and outdated. Its website felt clunky and behind the times. Its profit margins were completely swallowed by debt service. Even when new hot toy trends emerged, the company was paralyzed. They had to watch helplessly as those must-have products flew off the shelves in competitors' stores, while their own stores stagnated. The private equity firms didn't just leverage the company, they completely constrained it. And in the fast-paced world of retail, being constrained is the same as being paralyzed. It was a death sentence. So, what's the big lesson here? The story of Toys R Us isn't some rare anomaly. It's a textbook case study of capital allocation gone horribly wrong, and it holds critical lessons for all of us. First and foremost, debt is never neutral. Sure, borrowing money can amplify returns, but it also dramatically amplifies risk. For Toys R Us, that $5 billion debt load meant it had almost zero room to pivot or adapt when the market inevitably changed. Second, those loan covenants destroyed its flexibility. The intense focus on short-term financial discipline completely strangled any hope for long-term growth. Executives couldn't take calculated risks or make bold investments because the lenders could pull the plug at any moment. Third, this structure, where the investors are equity-rich but the company is debt-heavy, creates extreme vulnerability. The private equity owners used other people's money to do the deal, but it was the company that had to carry the entire burden. And finally, innovation requires capital. Retail evolves at lightning speed. You need to invest in digital, in omni-channel strategies, in your supply chain. When a company's cash flow is entirely dedicated to servicing debt, it's impossible to keep up. And perhaps the most heartbreaking lesson of all, brand loyalty does not equal immunity. Even the most iconic, beloved brands can die under the weight of financial engineering. Nostalgia, it turns out, cannot pay interest. The lesson for employees, investors, and customers is crystal clear. You have to look beneath the polished surface of private equity. What looks like a stable ownership structure might just be hiding a ticking debt bomb. In the end, the collapse of Toys R Us wasn't a story of bad products. It wasn't a story of poor management or a lack of brand love from the public. It was a story of financial design, a story of a company saddled with a debt it could never escape, a story where interest payments were prioritized over innovation, and a story of a world that was changing much faster than its crippled balance sheet could handle. By the time the company filed for bankruptcy in 2017, the game was already over. It was far too late. So the next time you hear about a company being taken private or streamlined for efficiency, I want you to ask the hard questions. How much debt is being put on the company's books? What are the loan covenants? Does the company still have the freedom and the capital to invest in its own future? Because leverage can be a powerful tool. It can build empires. But as we've seen, it can also crush them from the inside out. If this story opened your eyes, let me know by commenting below. I want to know the truth. Share this video to warn others that not all growth is real growth. And please subscribe, because in our next episode, we'll explore another hidden danger in corporate finance that even seasoned CEOs often miss at their own peril. Thank you for watching.